good afternoon, and welcome to the Halftime Talk, the weekly feature interview show as part of the Daily Energy Market Series. We're delighted to be joined today by Mark Finley, a fellow in energy and global oil at the Center for Energy Studies at Rice University's Baker Institute for Public Policy, sitting in Houston, Texas. So, Mark, thank you so much for joining us.
It's my pleasure, Sean. Thanks for having me.
Well, Mark, let's kick off with a very quick reference to the news of the day, if you like, which is all things weather. What's happening in Texas? Is it a repeat of last year's nightmare, or is it passing by?
So, and I apologize. I'm actually based in Washington, D.C. I commute down to the Houston campus, but I am not based there. I'm not there right now.
Okay.
But what I hear is that there have been some isolated outages as ICE have brought down power lines, but not a systemic threat to the power grid like we unfortunately lived through last year.
I mean, the whole of the East Coast, where you are as well, was, this winter storm that was sort of impacting markets last week was blowing all the way up the East Coast, and even to the extent where there was a heavy demand to burn fuel oil for power.
Right, absolutely. And in fact, we've seen, at least briefly, periods where natural gas prices in New England were higher than they were in Europe, which is saying something given how high prices have gone in Europe and for LNG cargoes, as I'm sure you and your listeners know. Yes,
there's no doubt the price on energy, and particularly LNG, when you take it on oil equivalent, as they do price LNG mostly, at least historically, we're talking about $300 oil, which is obviously off the charts. Nobody in their life would have ever thought something like that would happen. Let's get back to sober realities, however. Outlook for 2022, it's still the first week of February, so we can sort of take an opportunity to still say, what does the year ahead look like, even though we're all well above $90 oil on Brent and WTI. But in the last few weeks, we saw all the major investment banks giving their prognosis for the year ahead, from the very sober and somewhat bearish outlook by Citi at the $68 average, I think they've called on Brent, to the very bullish Goldman Sachs, which are north of 100. They seem to be winning the early race here. Your thoughts on those forecasts? Where do you think oil markets go after an average last year of about $70 on Brent? What's your sense of what we'll see in 22?
Well, there's no doubt that the market right now is very tight. You know, here in the U.S., where we get weekly official data on inventories, they continue to fall. We've seen some weather-related outages of supply. We've seen, some one-off accidents, like, the tanker accident in Nigeria. We've seen, as you mentioned, cold winter weather pushing demand even higher on top of the COVID-related recovery that we're seeing. Going forward, I think it's unusual. There's an unusual amount of disagreement out there among analysts. And I'm kind of in the middle. The people who think that prices are going to go continually higher, think we're going to run out of spare capacity. I don't see that. The people who think prices are going to fall very significantly think that the market will become dramatically oversupplied, in part because the OPEC Plus group will continue with its monthly production increases. Personally, I mentioned I don't think that the world is in imminent danger of running out of spare production capacity. I see robust growth seems to be expected here in the United States, and we can come back to that. We see growing production in places like Guyana and Canada, elsewhere, on top of the OPEC Plus plans. And there's still significant spare capacity, especially in the Gulf countries, even as other OPEC Plus countries are kind of running out and having trouble keeping up with their planned production increases.
One of the things, Mark, one of the things that seem to be maybe distorting the perception, yes, tight market, but is it $90 plus tight, or is that an inflated number given the geopolitics that we're currently seeing? Of course, you're sitting in Washington, as you said. They must be, buzzing at least. It seems every day they're coming out with a new headline, sort of nearly the boy who cried wolf. Though it's today that Russia will invade Ukraine. No, it's tomorrow. I mean, it seems Washington are rushing every day to give that headline, your own sense of where geopolitics is inflating the oil price, and particularly where do you see the issue on Ukraine going?
I tend to be more of a fundamentalist when it comes to prices. I think you can justify a lot of the price increase that we've seen on the basis of a very tight supply and demand balance. It is certainly the case that geopolitics have become a bigger focus. I mean, for both oil and natural gas in Europe, for example, over the Russia-Ukraine situation, shall we say. And the market, the market never seems to worry about geopolitics when it's well supplied, only when it's tight. And so we have a tight market.
Which is what we've seen for most of the last 10 years, a fairly well supplied, quite a, shale obviously being the big bonanza. And so geopolitics faded into the background. But as you say, we're very much to the fore at the moment because of tightness. So let me come back to that question then. How can you be a fundamentalist and be so blasé, laissez-faire, that this is a year in which the second half is going to be all fine and dandy and it's just tight now? I mean, there's a lot of signals for tightness right through the 12 months.
Right. Well, and again, there is debate over that. As you mentioned, Citi and others who have relatively bearish forecasts see that the market will flip in from a deficit currently to a significant surplus over the second half of the year. Personally, to the degree that is contingent on the assumption that the OPEC Plus group continues with its current plan of adding 400,000 barrels a day of target every month, I don't understand why the group wouldn't hit pause if they faced a prospect of sharply lower oil prices, because of an oversupplied situation.
Well, they've hit pause, haven't they? I mean, ultimately, they're hitting maybe 50% of the production increases that they announced since last August, 400 every month. But ultimately, they seem to be only banging about half of that out of the park. So we're already in the sense of pause, and this that 20 of the 23 countries practically cannot give anymore.
So, but the ones who matter do still, increase production, and the question is, would those countries, including those in the Gulf, continue to increase production even by 200,000 barrels a day if it's going to push the market into oversupply and push prices sharply lower? I fail to see the logic of that personally.
Well, I don't think that that's certainly not currently the case in the context that it seems that we're more in a market where there is concern out of where supply is tight rather than a demand robustness. The challenge of the thesis that there's plenty of supply capacity is that, of course, every time OPEC Plus and OPEC really, and as you say, the Gulf OPEC members increase production every month, it's a barrel closer to running out of spare capacity, right? I mean, that is the fact until this non-OPEC plus supply comes from somewhere. Let's go to that. The biggest story of the last year has to be, where is shale gone? Oh my God, $80, $70 oil. I thought you guys had got this thing down to a $30 fine art. You'd be making fortunes at this level, and yet it still seems to be on the slow boat.
Well, and companies are making a fortune at this level. It is important to note that production is growing. It has recovered significantly. It's not back to where it was pre-COVID, but it is growing. But the pace of recovery has been surprisingly measured given how high prices have gone. And that it has more to do with the shale investors than it does with anything else. After the price collapse in 2020, shale investors essentially said, we're not going to fund growth. We want you to focus on cash flow and return cash to us. And so, the profitability of the U.S. shale patch last year was an all-time record high, even though prices were below previous records and production was below previous records. Profitability hit a record high last year.
How much was that based on the stress of the supply chain, squeezing the supply chain to the point of a fraction of a margin? And can that be sustained is my point.
That's a piece of it. I think that there's been a lot of other tactics that have contributed. I mean, it has been a relatively measured the rate of growth of the domestic rig count is pretty slow compared to what we've seen in previous boom cycles. So it really, I think, is primarily around the discipline of the drillers themselves. Yes, the supply chains have been squeezed, but that pricing power is coming back. You're starting to see people talking about inflation, in their cost base. But I think one of the real secrets that people haven't really paid attention to is this question about the ducks. The shale operations is a two-stage process. You drill a well, and then you complete that well and bring it into production. That's where the completion is where the fracking process actually takes place. And there's a natural gap between when you drill and when you complete the well. And in that gap is an inventory of wells that have been drilled but uncompleted. And that's what the industry calls the ducks. And here's the big secret. Since COVID, since the industry began to recover in the summer of last year, the inventory of ducks in the US, according to official data from the US Energy Department, has fallen dramatically. In other words, the industry has been able to sustain its production without having to drill a lot of new wells. But that cannot go on forever. When that inventory of surplus drilled and uncompleted wells is exhausted, I estimate that you would need to have 30% more rigs working just to have the same base impact on production. And
where
that's
do you
before
think
you get to growing?
Where do you think that sort of strategy goes? I mean, the idea of, as you said, return on to investors. Where's the financing piece of that coming back? There's been banks have, as you said, in the beginning of the COVID stress period, backed away quite strongly. What's their incentive appetite to return Wall Street into sort of Houston Street, if you like?
It's starting. I mean, at this price, the reality is you can do both. You can drill more wells and you can continue to return money to your shareholders. So I think you're starting to see, both from a company perspective and from a investor perspective, a bit of loosening up of that attitude toward being willing to drill more. We're seeing more companies announce plans to increase their pace of their drilling, for example. 9 months ago, if a company announced that, their share price would take a hit. Now that's not the case. And there's also been another change in rhetoric from the policymakers here in Washington, D.C. Now the U.S. government is actually asking the shale patch to increase its investment in production because they know that rising prices at the pump are a major economic cost, but also a major political vulnerability.
Before we get into that sort of that green agenda piece, but just looking at the other elements impacting shale and financing being one, the return of capital for the shale investment, where and what is the impact, or will there be an impact, the fact that we're now going into a tightening cycle, and maybe, given what Jay Powell and the central bank is indicating, an even accelerated one? It seems every week you open up your news sources and it's, oh no, it's not 3 rate rises, it's 4. No, it's not 4, it's 5, it's 6. So actually the first one in March is going to be bionic. It might be 50 or 75 basis points. What impact could all of that have on this recovering shale production?
Everything that was a tailwind helping U.S. producers over the last year and a half is about to become a headwind. Interest rates are likely to rise, costs are rising. I personally think about it. When the industry contracted, we saw a significant increase in productivity. Well, that's not surprising in the sense that the only thing that's left is the best crews working on the best rigs on the best geologic prospects. So productivity was a tailwind. The costs of your supply chain was a tailwind. The cost of borrowing money was a tailwind. Now, as you go back to work, you're going to be stepping out into less productive acreage with less productive crews, and less productive capital. And so all of these factors that have been factors working to the advantage of the shale patch are now going to start to go in the other direction. And I think that that's one of the reasons why I'm cautious about, there are some forecasters projecting that U.S. supply will grow by over 1 million barrels a day this year. I'm a bit cautious for right now.
Well, what does cautious look like? We had Ryan Lance, the CEO of ConocoPhillips, over the weekend, kind of given a cook with a coal mine, was not a warning, but essentially a wake up. This is a lot bigger increase in 2022 than people are expecting. What would your number be? Under a million by the sounds of it.
Under 1 million, I think, until I see otherwise, because like I said, I mean, you're going to have to increase the number of rigs working by 30% just to offset the DUC inventory. That's just to stand still. And the rig count, has been growing, but in the last couple of months, it's grown by maybe 10 or 15%, not by 30 or 40%. There are massive productivity gains still taking place in the industry. The drilling longer wells, the much more sophisticated process of analyzing and fracking and completing the wells. Those are significant productivity gains that will stick. But again, when I just look at the high level numbers, I have trouble seeing where the gains of investment will come from to drive an extra 1 million plus barrels a day of supply.
Let's just talk a little bit about all things green policy. That's been another sort of criticism of why the U.S. production has not returned in the same way, or indeed globally, new oil supply has not grown because of the accelerated push towards the energy transition. And particularly Biden came into office very much with that front and center. 1 year later, literally into his administration, where does his green agenda lie? And how much do you think it is the blame, or it is the trigger for this sort of capacity crisis that could be on the horizon?
I personally think that's been overdone, Sean. I mean, the main reason why the investment community has been cautious is not because of long-term climate policy. Let's face it, these wells have a very quick payoff. Their production ramps up quickly and falls quickly. It's about the industry's failure to return capital to its shareholders for a decade. It is an article of faith in the U.S. oil patch that the U.S. administration is out to get them. And yet, the pace of, for example, of giving new leases on federal lands has actually been more rapid than it was at the tail end of the previous administration. So yes, there is prospect for closer regulation of methane or of water, but frankly, that's happening even at the local level. In Texas, the Railroad Commission is under pressure to more closely regulate water produced by wells, for example. So there is that, but I don't think that's the main driver. And I do think that we've seen some, let me put it this way. I think there's a growing realization among policymakers in the United States and in Europe that aggressive action to deal with climate change doesn't mean you get to ignore today's energy sources. Because let's face it,
right?
Fossil fuels are still 85% of the world's energy mix. And any politician, at least in an elected democracy, any politician who is seen as failing to provide sufficient affordable energy today won't be in office long enough to successfully deal with climate change. So this is why you see the U.S. administration asking OPEC Plus to increase production and to release strategic stocks and encouraging U.S. oil producers to increase their investment, because they know that higher prices at the pump are a major political liability for them.
Has that sort of horse already bolted in terms of the political impact of this current cycle of higher cost energy with the U.S. midterm elections now 9 months away?
Well, the bad news for President Biden is that prices at the pump correlate with his job approval rating. The good news could be that the same thing. I mean, if prices were to come off, that would provide some relief to voters/drivers. By my estimate, the increase, the U.S. prices at the pump last year had their biggest 1 year increase ever. And the 1 year increase in gasoline prices alone cost U.S. drivers an extra $110 billion. And by the way, guess where that falls? It falls primarily on lower income households. We've been doing some research at Rice University that show that aggressive subsidies for EVs have helped push rapid growth of EV sales. But guess who buys those new EV cars? Wealthier households. In fact, on the data from a national survey produced by the federal government, wealthiest households are something like 15 times more likely to own an electric vehicle than the poorest households.
I mean, it seems to me that the president and his allies are going to have to get better at articulating that. Yes, higher gasoline prices may have cost 100 billion, but I just gave you $2 trillion in free checks over the last few months, and I created I don't know how many jobs last year, but certainly it seems to me that the macroeconomic picture in the U.S., at least from this distance, looks incredibly impressive.
Yes, and it is, and that's all very fair, Sean. If you put it in the bigger context, the U.S. economy is growing very strongly, and jobs are being created. But the price of gasoline here is. I mean, I can't tell you what I last paid for a gallon of milk, but I can tell you to the 10th of a cent what I paid for a gallon of gasoline. And it is, it's the signs are on every street corner in letters that are a foot and a half high, screaming the price at you. And so it has an outsized impact on things like consumer confidence because you see it everywhere. So I think you're right that the big picture is that the economy is doing well and continuing to improve. But that doesn't mean that prices at the pump and inflation more generally, aren't an issue to grapple with.
They certainly are. I mean, and I think in some regards, the Fed has lost or is behind the curve on that, and so accelerated rate rises are going to be adding to the somewhat maybe austere year that is ahead in a little bit. But coming back to the investment in new oil capacity, it seems in some ways a kind of counterintuitive catch-22 challenge for the majors, and that the more investors shy away from oil and oil equities, in some ways the stronger the rebound. What's your own sense of that? That the more, if ExxonMobil was to announce $10 billion, $50 billion of investment in new E&P tomorrow, oil prices would probably fall.
Well, funny you say that. ExxonMobil has, in fact, announced aggressive plans to expand its drilling in the Permian Basin, and their share price is outperforming the stock market over the in recent months. So I think you're beginning to
see that $10 billion buyback was probably a help there.
That could do, but I mean, I think you're beginning to see more balance by investors that it can't be all fossil fuels, but it can't be all only green. You need one of my key themes is that we need to do both these things at the same time. We need to make sure there's enough energy today to run the economy, to get our kids to school and to heat and cool our homes and to cook our food. And we need to pursue a transition. And those two aren't mutually exclusive. In fact, we will fail if we don't manage to do both of those at the same time.
We, in the bigger, wider world, we kind of get blinded to see America and the US through the prism of Washington and inevitably the dysfunction of Washington. And so the perception is, of course, there's a lot of dysfunction in America. But if one gets away from that prism, the US ratified all of the conditions of the Kyoto Protocol without actually officially ratifying it. Like, my point is America as a whole, beyond the prism of Washington, D.C., actually getting that balance better than we are perceiving it to be? Or what's your sense out there in the U.S.?
Mm-hmm. A very fair comment, Sean. I mean, I think it is important for people outside the United States to recognize that policymaking is very decentralized. The federal government does not have all of the authority. And so we do see at the state and local level much more interesting set of policies. And let's face it, one of the reasons why the United States has made good progress over the last 15 years or so in reducing CO2 emissions is the shale revolution. The fact that cheap natural gas was able to displace coal in power generation played a big role in reducing U.S. CO2 emissions, in addition to the growth of renewables. I mean, in Texas, where Rice University sits, has the biggest the biggest installed base of wind solar capacity in the world. And it wasn't because of federal policy, it was because of policies at the state level. So I think that's a good point that you have to.
And also, I think was sort of one surprising factoid of 2021, and there was a few, was Wyoming isn't far behind. You couldn't get two redder states. Wyoming is becoming the wind capital of America, certainly on a per capita basis.
Right, even as it's still the biggest producer of coal as well. That's where the wind is, right? These are the
that's the point you make ultimately, is that balance. We've seen in Europe coming out of the great energy coming out of COP26, this sort of massive, at least political policy acceleration to transition, wishful hope in a way, rather than actual energy availability, and the crisis, the shortage we've seen there reflects not all of that, but that sentiment. Obviously, the US has taken a more sober approach to the transition. In Europe, we've seen the majors, BP, Shell, they're shouting louder than anybody about their commitment to the transition. In America, less so. But I'm just coming back to that question. Is that happening in America now? Is that transition, can Biden, whether he gets reelected or not, is this transition happening? Is there a commitment to it, to see it through, purely because the economic returns are so positive?
It's happening. It'll happen, at the pace at which it happens can be massively impacted by federal policy. The federal government is reviewing the social cost of carbon that it uses in setting government regulations. But again, Texas is building wind, and Wyoming is building wind. The city of Houston has just launched a major initiative to build a carbon capture hub. To say, well, how look at all the resources we have that will help us to compete in this new world of a constrained carbon energy system. So I think a lot of that is happening, and big companies in the U.S., like elsewhere around the world, are moving with or without federal action. So I think while there's big scope for the federal government and decision making there to impact the pace of change, I think the direction is pretty clear, and people aren't waiting for that.
Well, coming back to the sort of earlier point, and maybe wrapping up on this, is the oil production in the US, your outlook a little bit sober for 22, but still positive. What's the sort of 3 to 5 year horizon for US oil production? Do you think we had a commentator on last week who's forecasting multiple new highs in US oil production through the next 5 years?
Right. I mean, I think the race will be between continued innovation to drive productivity gains versus the depletion of the best shale prospects and having to step out into lower quality ones. I see just over the weekend, some U.S. shale executives were quoted as saying that they have a 10 to 15 year inventory of good prospects that are economic and money making in the current environment. But if they ramp up the pace of drilling, that becomes more like a 5 to 7 year window, at which point then you have to start thinking about, well, where are the next good productive resources. I could certainly see U.S. production continuing to grow through the medium term, perhaps not by the 1 million to 1.5 million barrel a day annual increments that we saw pre-COVID. But it certainly looks like the resource and the capability of domestic industry is there to continue growing at a measured pace.
At a measured pace, but possibly hitting new highs, you would think, over the medium term.
Yeah, I think that's very, very possible. If on the more bullish forecasts that are out there, could be by the end of this year.
Yeah. I think
I'm cautious, but
I might be in that camp myself, because I don't see this a year of two halves. I see this as one tight ear, a bit like shale rock. But Mark Finley, we have to wrap it up there. Fellow in Energy and Global Oil, Center for Energy Studies at Rice University's Baker Institute for Public Policy, not in Houston, in Washington, D.C. Thank you very much, Mark.